This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Today's show features Eric Bielke, Investment Director of GE Ventures. Eric, thank you for joining us.
Hey, pleasure to be here. Thanks for the invitation, Hall.
Good to have you back. We had a previous interview in which you talked about the state of investing in startups as well as your advice for investors in startups who are raising funding. So today, can you give us a short update about yourself and what you've been doing since our last interview?
Sure. I'd say it's been, 9 months, maybe 6 months since we last spoke. I guess not a ton has changed, although the world's kind of stopped on a dime about 6 weeks ago. So that has certainly changed. And I think you talk to anyone in the venture space, they'll say that their investing outlook has certainly been affected. Ours has as well. There's no doubt people are changing terms and pricing. And, in some cases, VCs are more active. In some cases, they're less active. Certainly a gravitational pull towards anything that regards remote work or healthcare right now. But outside the macro, for myself, I'm one of the partners of GE Ventures. I focus on deep tech, enterprise automation, and marketplace models. I've been here on this platform for about 6 years. Before that, I spent some time at another investment firm called Next 47. And the kinds of things that we invest in are really pretty broad. And I think we're generally a corporate venture capital fund. Our mandate, though, is to chase high quality, low risk investment returns. And we try to adjust that risk adjusted return as much as we can to be favorable. We obviously look for opportunities to support companies when they're working with GE, and we use our personal networks as much as we can as well to get companies in front of the right people, and then sometimes we introduce potential future hires and do a lot of the same kind of sleeves rolled up type of work that is common for investors in helping build companies. So I would say, from the perspective of what's happened in the last 6 months on a personal front, I guess my wife is having a baby in August. That's sort of been a big change on the
congratulations.
On the work front. I appreciate that. Thanks, and we're excited to add one to, I guess, our portfolio in the family sense. And we continue to be probably a little bit less active in the market given recent events, but we're still talking to a lot of entrepreneurs and closing deals and doing follow-ons.
Well, great. So let's talk about your investing experience. You've had quite a bit and looking forward to learning more. Is there any particular company you regret not investing in? And why didn't you invest in it at the time?
That's a really interesting question. And I guess I've been fortunate. I've been in this business for about 8 years. And so had enough of an arc to see what works and what doesn't and know where I made some mistakes. One company actually, because I know we're going to talk to national security as a topic in a little bit. One of the things that I remember is speaking with a founder right around the time they were raising their Series A for a really innovative satellite company. And the company is Capella, and the founder is a really dynamic and very energetic individual. And basically the concept is, there's lots of ways to take imagery of the Earth from space. And I think as we actually talked about last time, there's a lot of applications for that kind of Earth imagery, and people are starting to find that high resolution images at any given time of day is not just useful for national security, but it's also turned out to be useful for agriculture, for monitoring and measuring oil movements, manufacturing capacity. And it's a way to kind of bringing the offline physical world online and to count things and make insights from that data. And Capella had a really interesting idea, which is, turns out that 50% of the time, most of the world's covered by clouds, or it's in darkness and you can't see much. And so there is a technology we've had. It's really not a new technology. We've had it since probably the 1950s, called radar, that can see through clouds and can see through the night sky. But it's very tricky to deploy. It typically requires a very large aperture and very large antenna, and it doesn't fit well into a small satellite, which is part of the thesis behind companies like Planet that got these small satellites off the ground. So what Capella figured out is how to make basically a very large synthetic aperture radar satellite, but in a very small box. And they did this by creating antenna that was soft. It was kind of a floppy disk, as it were. Not in the traditional kind of 1980 sense of a floppy disk, but it could unfold in orbit. And if you know a little bit about how radar works, right, you need a certain arc over a period in order to have a bounce back of the signal from the surface of whatever you're measuring back to the radar. And synthetic aperture radar has been used by planes and very large satellites for a period of time, but this was the first time it was really possible to do it in a very small format. And there's a lot of tech risk associated with anything that's involving space. And as you can imagine, we spent a lot of time trying to diligence the technology and whether or not it was workable, also appreciating that there are risks with space, including getting things launched on time. If anyone who's ever tried to get anything in orbit, small satellite or otherwise, can tell you. So we got to the end of our diligence process and we passed. We thought the price was too high relative to the risk. It turns out that Capella did launch, and they actually now have one of the best performing synthetic aperture radar satellite constellations out there. They went on to raise more money, and the story in this company, as it is for many others, isn't completely clear. This isn't founding to exit, and we already knew we lost money, but the momentum has been very good, and I think people have started to appreciate that synthetic aperture radar will probably eclipse the colored images that we see from Landsat or Planet or other companies that are doing that sort of work. So it was a miss. Regrets on our part. We spent a lot of time there and have a ton of respect for Payam and his team. But yeah, I say you got to learn from those failures. When your research is real strong, and even if there's a lot of risk, and you can take a portfolio approach to some of those risks, better to bet than stay on the sidelines.
That's a good one. It's hard to pick all the winners because they don't always look like winners up front for sure.
That is the nature of the game. That's true.
And so, well, we're in a changing economy here, going from one to another, and a 10-year bull market going into what we call the coronavirus economy. And so,
hopefully not a 10-year bear market, right?
I doubt it. I doubt it. I think
it's
just a reset. Whenever you have this, we just reset from overvaluation to undervaluation, and then start making the long, slow climb back up. And we'll be doing another 10-year climb, is my estimation, but we'll see. And so in this next round, what sector are you passionate about and why?
Well, I'd say there's two areas I tend to spend a lot of my time in. And this is actually both as an angel investor as well as an institutional investor. I'd say the first is climate tech. That's been an area that's been hot for some time. I think it's kind of come in and out of fashion in the early part of this last decade. Maybe, green tech or clean tech was a first decade of the 2000s term, and then climate tech is the newest nomenclature, with a valley in the middle where it actually wasn't all that popular, since there'd been a bust of companies like probably Solazyme and Amyris and many of the biofuels companies. And then of course there's a couple of solar companies, US solar companies, that went bust around that time. People kind of lost faith. And my view is we've actually been starved for capital in that area for some time. It's coming back with a vengeance. One of the numbers that sticks in my mind is roughly $4 trillion in assets earmarked for ESG funds has been allocated. You can measure that obviously as both debt and equity as well as private equity, but it's a very large number. And I think as people start to move more money into ESG indexed or ESG focused ETFs or other investing vehicles, we're going to see more money show up in climate tech and sustainability to support some of these companies as they go public or as they raise more money. So that's one. And obviously there's some particular companies I'm interested in, and there are a couple of things that are still tough about climate tech. Number one, I think mistake investors made back in the late 2000s was they invested in companies that even when you were producing at full volume from XYZ manufacturing plant or factory, the gross margins on things like fuels just weren't all that good. Probably Kior is a good example of a company that, at its best case is probably producing in the neighborhood of 25, 30% gross margin, and really hard to make a business that doesn't require a lot of cash by doing that. I think there are some really interesting companies that are coming out of the storage space, energy storage. TOA Technologies is one that some of the listeners here may know, which is basically a company that's trying to do one of probably the hardest thing in lithium-ion batteries, which is they're trying to take the cathodes that are typically made of nickel, manganese, or cobalt, and they're trying to turn those into silicon. But silicon has some properties that make it not very easy to work with. It doesn't withstand becoming brittle when you push electricity through it. So you need to have a microstructure that enables it to not break. And Sila's been doing a pretty good job with that. And if they are able to crack that case, the expectations is they'll be able to improve by about 25x the lithium ion capacity of a given unit of battery space. That'll be powerful in the energy storage economics. And then a couple of other companies like TIAX, which is a company that makes next generation cathode materials with less nickel and less cobalt. QuantumScape, which has been working on lithium metal anodes for a while, and Skiomatrix, which is actually doing the same, but is a Chinese company. Those are all pretty interesting, I think, on the climate tech spectrum. And then the other area that I spend a lot of time in is national security. And this is a long-term trend, I think, not because we're going to have more spending at the DoD level, at least in the United States, which we are. I think some of the best analysis I've seen of government budget expectations into the mid-2020s is that DoD spending may actually approach, it's around about $700 billion or so a year now. It might approach north of $1 trillion by 2025. And then, in the upside case, not the upside case for maybe civilization, but in the high case, without some sort of conflict, it could be as high as $1.5 trillion, which would be roughly double today. It's a big buyer. And that's just the United States. It's not counting for other defense departments outside. So I think of that as an interesting macro. There's not a lot of venture money right now chasing national security as a focus area. There's a ton chasing cybersecurity, which I think is a distinctive domain that you'd wrap under it. But the kinds of companies that I'm spending more time with include companies that are doing surveillance, whether that be from drones or from satellites, companies that are enabling human-machine interface, and so allow people to control bots from far away, ruggedized robots. People are very familiar with ghost robotics, but I think there's a variety of cool technology that's around augmenting humans, like a company that's a portfolio company of ours called Sarcos Robotics, which makes exoskeletons. And there's a lot of companies that I've been in discussions with that are making software that really just enables organizations that either sell to the military or are part of the government work better, right? In some ways, that's actually a large and very underappreciated opportunity to just get enterprise IT improved for the sake of getting all the systems that are already in place, not inventing anything new, to run as efficiently as an Amazon distribution center and run as efficiently as Google does. So there's a lot there. And I think that's going to be an area that doesn't kind of come in and out of fashion quite the same way as climate tech, but I'm spending a lot of time in both.
Well, it sounds great. It sounds like climate tech is going to receive a lot more funding now at this point than it has before. And it seems like that's a critical factor. Will it get funding and so forth? And how much of that funding you think will be driven by the government and how much will be driven by private enterprise because it's going to be demanded by the consumers?
Well, in the space of national security, we're looking at companies that can sell to both. I think there's been a fairly extensive graveyard of companies that were exclusively selling to the military, and they might have had DARPA as a customer, they might have had the Army as a customer, but they didn't have another commercial application outside that. And part of the challenge for the buyer is that they can't really decline to give another contract, and so some waste kind of enters into the equation because they know if they don't give that contract and the company goes away and then the technology doesn't stay on the market. And from the company's perspective, it's awfully hard to have just one customer because all of your eggs are in one basket and you don't get that product feedback cycle that you typically do when you're selling to multiple customers. Everyone has different needs, and so you actually do want some diversity just to help improve your product. We're seeing a little bit of that change now. There is a couple of organizations sponsored by the DoD, AFWorks, which is the Air Force derivative, which is probably the best known, now called AF Ventures, is a sponsor of contracts that go to companies, startup companies that are matched by venture capital and that have a dual military and commercial purpose. And AFWorks, under the direction of Roper, have been making fairly significant investments, say really not both investments as well as deployments of funding that are not, not for equity into new companies. There was just a round last month, actually, or March rather, that what you'd call phase 3 grants, and I don't remember the number that was awarded, but it was in the order of hundreds of millions of dollars that went to young companies that had proven technology, already an existing customer list, and that the Air Force knew it wanted to work with. They met these criteria for having an external commercial client, as well as matching venture capital. I think we've been really interested in that, ability to work with the Department of Defense and get some of the ideas that might not be coming from, say, a Lockheed Martin or Northrop Grumman or a traditional prime contractor, and see if we can back the companies that ultimately become the next of that relatively close breed. I would include GE as part of one of those prime contractors. So I may be throwing a little bit of dirt on my own enterprise there, but I think disrupting some of the legacy companies that are been selling into the military for, say, the past 50 years is probably a healthy thing for the country.
Well, are there any sectors you personally avoid and just don't invest in, and why do you avoid those particular sectors?
Yeah, it's all about smart capital allocation. So I suppose the answer varies depending upon what time period we're in, right? If you'd asked me what was the sector to avoid back in 2008, I probably would have said, even though I'm enthusiastic about climate tech, I would have said, don't invest in solar module manufacturing, right? Really tough space, and very likely that some very well-funded Chinese companies are going to win that hands down. You don't want to go there. Now, actually, there are some really interesting ideas in solar in terms of module enhancements, for example, that I would get behind. But as a general rule, I don't spend a lot of time thinking about advanced materials. We've got some really interesting technology in that space, but I found it hard to find companies that are running better than 30-40% gross margins. If a company is not kind of producing a sufficient amount of cash on a unit economic basis, it's really hard to scale that without considerable amounts of additional debt or equity. It's a relatively gross simplification, because there are some companies that clear that bar in the material space, but by and large, I don't spend quite as much time there. I try not to spend time on companies where I think the break-even point, or the point at which they reach operating leverage and don't need new capital unless it's strictly for growth, is more than 50 million. That's a little bit of an arbitrary target, because obviously it changes by industry and technology type. But there's a sort of a point of inflection in how much risk you take on if a company's going to need much more than that. And personally, I don't know a lot about healthcare. Actually, my wife, who works as a physician, is really steeped in that. And we do have a couple of healthcare investments in our personal portfolio, but I tend not to spend a lot of time as a software investor in healthcare, just because you can't know it all. And even though I see some really exciting things happening at the intersection of machine learning and genetics in particular, it's not worth getting to be too generalist.
Absolutely. So what's your worst experience with a startup?
Oh, that's a tough one. I would say I've never had a really bad experience with a company. These are always hard fights, right? You're kind of backing David against Goliath, no matter which investment you choose. I would say one of the hardest investments was one I inherited from some colleagues when I joined GE, and the company had a very cool climate technology, and the company still exists. It's just, the reality is it's just been very capital intensive, and I really would love to see them accomplish their mission. But at the time I took it on, it just took a lot of effort. The company was formerly called Skyonic, and as a real quick brief on what it does is the company takes salt water and electricity, combines those together to produce caustic soda and bleach, and it can sell the bleach on its own. It also produces a fairly significant amount of hydrochloric acid in that electrolysis process, and it can sell the hydrochloric acid on its own, but it keeps the caustic soda, and then it mixes the caustic soda with waste CO2. In this case, CO2 that comes off a nearby cement factory, and could be CO2 from a coal plant, could be CO2 from another industrial process. And the combination of CO2 and caustic soda produces, and the beauty of that is sodium bicarbonate is just another commodity, right? You've now sequestered the CO2 and into effectively a mineral. So it's even better than what people have been doing with CO2, which is oftentimes dumping it underground and using it to extract more oil, or just taking it out of the atmosphere at very high cost and sequestering it into the ground. So being able to turn out a carbon intensive product with some known technology, namely this process for doing electrolysis of water, and then combination of caustic soda with CO2 seemed a very good bet. And we raised 500 million or so for the company, which again violates probably one of the rules I was talking about earlier, which is maybe why I won't go to companies that are looking for that kind of funding again. But it was a lot of financial restructuring. Building the first plant to get it fully operational just took much more money than anyone anticipated, and money came in drips and drabs. And so there was a lot of effort to raise funds, oftentimes on tough terms, oftentimes with expectations for getting things up and running and in a good spot in 2 months or 3 months. And oftentimes those estimates would be off by a factor of 2 or 3. And the engineering challenges are significant when you're building anything at scale in the manufacturing space. The bicarbonate would clump, and then it wouldn't come out of the feeders correctly. Turns out the train cars that we had run into the factory were kind of crowded too close together, so they didn't fill right. And these are harder problems to solve than, for example, we get a bug in the software, we got to go work it out, right? These take fairly significant amount of dollars and time to troubleshoot. And so we just ended up in a situation following this company for quite some time, investing a lot in it and continuing to kind of bang our head against the wall, trying to get this factory to be fully productive. I'm very glad to say that the company is under a different name now. It's not Skyonic, and it is producing those commodities that I mentioned, and it is starting to scale. So there's good news in the back end of this, but it was a lot of work for probably a solid year and a half in the early days I was at GE.
See, and what would be your best experience with a startup if you had to pick the winner of all of them? What did you have the most fun with?
Yeah, that's also a good question. I'd say on the flip side, right? I was just talking about a very capital inefficient business, or at least for a period of time, very capital inefficient. I'd say one that was very capital efficient, obviously went very well. I was a very early investor in a company called RigUp, maybe familiar to you in the Austin ecosystem. Okay. RigUp is a supplier. Well, it's a marketplace, right, for contract labor. And the company had its roots in, as sort of the name implies, in the oil and gas space, where people need certifications and they need a certain amount of training in order to be able to perform the work. And the company got started basically taking this cohort of individuals and small firms that were technically very strong, but were kind of working on a project basis, and then exploration and production companies that were looking for diversity in their supply chain and wanted to work with the best firms, not necessarily the firms they were most familiar with. And this marketplace would match the two. And we evolved the business model over time. It wasn't quite that simple back in the days when we got behind the company. But what did happen is we saw there was a lot of transaction volume happening on the marketplace. And it wasn't a couple million a month. It was more like 100+ million a month. And what it made us realize is that even though there wasn't any money flowing to the bottom line, there was definitely some magic happening. And we kept watching the monthly transaction volume grow. And I think, got conviction that whatever direction we want to take to monetize this platform, it's going to be effective. And so we made the Series A investment, and we've obviously followed on and brought in a lot of other additional investors since that time. I think that was back in 2015. But yeah, it's been a great story. I'm really proud of the work that Shen and his team have done. And yeah, it's obviously a lot more fun to be across companies that perform really well than companies you have to kind of dig in and do some restructuring.
Absolutely. Those are the fun ones for sure. So if you see the companies today in the market, what would you say the main challenges they face are? I know we're in a transitionary economy here and there's short-term issues, but what do you think the longer-term ones are going to be?
Yeah, well, my heart really goes out to everyone who's struggling with the layoffs or just kind of tamp down expectations for 2020. And if you're a founder, we've been doing our best, obviously, to support the companies that we've been across. And it's a tough time. It's a tough time for those that have to make hard decisions. It's a tough time for those that are affected by those hard decisions. And hopefully be out of this short-term storm soon. If I look longer term, though, and just kind of wax philosophic for a second, I'd say in energy tech, it's really the bottleneck right now is on talent. There's a lot of money chasing deals. You could make the argument that there might even be too much money, but I think this is a civilization level problem that we need to solve in order to decarbonize and take a lot of waste and pollution out of the ecosystem. So if there's too much money chasing, it's actually, on balance, probably a good thing for all of us. Without that shortage of capital, what we really need is more talent. And whether you love them or hate them, we need more Elon Musks of the world. We need more people that are mission driven and that have so much fire in the belly they can kind of take on these legacy industries and build really high performance products that are clean and don't have some of the same impacts. So that's probably the biggest challenge I see in climate tech. In security, this is an interesting space because there's historically been a shortage of capital. I think we've kind of rebalanced that now. I'd say talent and capital are probably right where they need to be. But for those that are on the buy side, whether they be prime contractors or they be the military itself or they be other kind of commercial entities that are steeped in the legacy of manufactured goods from 10, 20, 30 years ago, it's a tolerance for risk and for taking a flyer on that pilot or doing that proof of concept without 4 or 5 decision makers that have to get involved in order to deploy something as a check as small as $50,000 to $100,000. I think we'll need, in general, a willingness to see companies fail and a bit more risk taking by providers to the basically enterprise buyers in national security. Obviously, we don't want our soldiers and our systems to fail in the field, but perfectly okay for things to fail while they're in startup mode. And we have to kind of create a little bit of more of a culture of risk taking, I think, around that particular sector in order to see successful startups that can get traction quicker and frankly also just advance the mission, which is make the world a safer place.
Great. So you see a lot of sectors and applications, and if you had to pick 1 or 2 to put at the top of the list for good immediate opportunities to pursue, what would you put at the top?
Well, those that I've been talking with recently know that I'm really interested in security for artificial intelligence. I think that's an area that I'd be excited to talk to interested founders about, and that maybe doesn't get well understood. So I'll unpack it a little bit. The challenge is that we have these great models to do things like drive our cars for us, but it turns out the models can be pretty easily fooled. And it's not the case that self-driving cars in 2020 or 2021 are going to have to deal with just the dilemma of an intersection with 2 or 3 obstacles and an ethical decision they might have to make about how do you slow down and stop, or if you have to have a crash, who do you crash into? I think that dilemma gets mentioned a lot in the press. The real challenge is when some nefarious actor puts, say, a speed limit sign that's not really there, like broadcasts a beam of light onto a tree at night, says this is a zone that you're allowed to travel 60 miles an hour. It's really only a zone you're allowed to travel 30, or artificially projects the image of a person or a crosswalk onto the street and fools the AI. I think we haven't seen situations like that today because humans are smart, and something that looks that out of place, isn't real. But in a lot of ways, machines are easier to fool. And because the record set in a trading database is so large, it's also very hard to detect when the data has been tampered with. So super interested in companies that can root out bad data for machine learning algorithms and have a way to kind of anticipate or simulate the bad actors that might be trying to fool algorithms. That's one. And then the other is, and this has been an exciting area for us at GE probably since the early 2000s, and I think continues to be one of the most interesting areas of deep tech is additive manufacturing or 3D printing. It goes by different names, and especially now that it's increasingly hard to run your factory on standard protocols, right? You're having to distance workers and supply chains are disrupted. One of the neat things about 3D printing is that you can make just about any part, any object, depending upon the diversity of materials. And we're getting better at that, but pretty much in the future, from any material on site. It doesn't have to come from a factory or a fab. It doesn't have to come from another country or another state. And right now, we haven't gotten to the point when you can mass produce goods at a cost that is with a 3D printing process that's comparable to what you'd get out of a foundry, say. But we're getting there. And we're bringing down the cost of the input metals and materials that go into the powders that make up laser sintering machines. We're getting sharper about binding objects when we need to produce a very very specific net shape, and it needs to be out of a robust material. It can't be out of plastic. That, I think, is quite disruptive to global supply chains and brings a lot of independence to manufacturing businesses. We've got a couple of investments in this space, Desktop Metal and Carbon, maybe the two best known. And I'm pretty bullish on this space overall in the coming, call it 5-10 years.
Those sound like great opportunities. Looking forward to seeing how they work out. So in the last few minutes that we have here, what else should we cover that we haven't?
Well, I mean, I think that we got pretty comprehensive. I'd say one addendum I'd add to this broadcast is if there are founders that are working across a couple of these areas, I'm super interested in meeting. And you can find me at eric.bielke@ge.com, or I'm on LinkedIn. I try to do a good job at Twitter, but I'm honestly an amateur, and I don't probably post enough, but easy to direct message me there. And yeah, always interested in having conversations with smart people. And I would say very much enjoyed being here.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Sounds good, Hall. Thanks again for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org.
Alti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.